Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for the week of July 13th. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. As we do each week, Steve and I will provide a brief update on the global capital markets, as well as insights into topics that we hope can provide investors with additional clarity in terms of what is transpiring in the economy and in the markets during this extraordinary time. To get caught up in the global capital markets, equity markets this week have been a bit of a mixed bag. After a sharp decline in the first quarter of this year, we had a very strong rally in the second quarter of the year. But it seems now that maybe investors are pausing just a bit here and really considering what I think are three main factors. First, corporate earnings. We're in the midst of the corporate earnings season, and so investors are really focused on what kind of guidance companies are providing for the future. Next, investors are also focused on the prospects for additional fiscal stimulus from Congress here in the U.S. This is very, very important because the stimulus from the initial program will be running out in just a few weeks. And lastly, obviously, investors are still focused on the coronavirus and the search for a vaccine. We have a resurgence of coronavirus here in the US, but really a great deal of focus is on, is a vaccine imminent? Will it be on the horizon? Will this be something that can happen this year, or will it be the middle of next year? The vaccine really is important for investors as they try to navigate the future of the markets. So now let me bring Steve into the conversation here. And Steve, last week we shared the money supply slide last week, and showing how the Fed had so dramatically increased the money supply in a short period. And here's that slide once again. We see the blue line, which shows the money supply, and we can see on the far right-hand side of this chart just an incredible spike in the money supply by the Fed in response to the global economic shutdown, which was in response to the global pandemic and COVID-19. So Steve, I think what we might do here, which could help, is explore in a little bit more detail this idea of governments creating money out of thin air. And I know that you have a chart that will help us through this. So let's have you explore that in greater detail for us.
So there's so many questions now about what it means for the government to literally print money out of thin air and how that affects the economy and the markets. And there have been economic theories developed about it, very dense academic papers, a lot of discussion politically, a movement called modern monetary theory, otherwise known as MMT, that espouses don't worry about spending, don't worry about debt now, just print all the money you can, do all the spending you need to do, and it'll all work out fine. Well, instead of just a theory, the pandemic has brought on a situation where we are now running that experiment in real life. We had the burst of money printing recently like we've never seen before. So the question is, how do we understand and how can we explain how that money printing really works and how that affects the economy and the markets? So I was recently having a conversation with my wife, Jema, and we were talking about this process and the mechanism. And what we realized was if we started to illustrate how this flowed through on a whiteboard we have at home, it was a lot easier to discuss and explain. And when we were done, we thought this might make a nice chart for our next video. So I'd like to show this chart. And we call this MMT, and instead of standing for modern monetary theory, we have a nickname for that called the magic money tree that's easier to understand. So what we have is a situation where the government needs to rescue the economy. We got hit badly by the pandemic. However, the government did not save for a rainy day. Rather than build a surplus during the good times so we have money to spend the bad times, the government continued to raise its debt level, continue to borrow money, even in the good times. And now we're in the bad times and it needs to raise the debt level even more and spend more money. So what does it do? It turns to its friendly central bank called the Federal Reserve Board, and it says, can you help us out? We need to borrow several trillion dollars to send money to help rescue the economy. And if we just go into the market and do that, to attract all that money in a very short period of time, it would disrupt the bond market. Interest rates could skyrocket. So maybe Federal Reserve Board, you could help us out. The Federal Reserve Board's answer has been, well, we're actually happy to help because our mandate, the Federal Reserve Board, is to not let unemployment get too high, and it's certainly too high now, and to keep inflation at a moderate target of 2%, and it's certainly below 2% now. So we're happy to add some monetary stimulus. Now, the normal way that the Federal Reserve Board does that is to lower interest rates. But after 40 years of lowering interest rates are now at virtually zero. So they can't lower them really anymore for much effect. So what can it do? Well, the next step is to literally print money. And what they don't do is they're not in the back room with a printing press printing dollar bills that come out the machine. But what they do is in their computers, with the click of a computer, they literally create out of thin air trillions of dollars. Then they take those trillions of dollars and they say, okay, government, you're going to issue all these bonds, but don't worry because we're going to be there to buy the majority of them. And they literally printed trillions of dollars. They bought trillions of dollars worth of bonds. And unlike in the past where they bought primarily government bonds and treasury bills, they expanded beyond what they've ever done before, and they began buying corporate bonds and exchange traded funds that buy corporate bonds and municipal bonds and mortgage bonds, and they intervene in the most major way. And so on the money tree chart, you see how we start with the government, then we go to the Federal Reserve Board, and then we go to the magic money tree where they created all this money that's coming out of the money tree. Well, it's got two places to go. One is into the financial system, and that's where they initially begin by buying all these bonds. And when they buy the bonds, they lower interest rates, and then that drives money into the stock market because the stock market becomes relatively more attractive as the bonds become less attractive as interest rates come down. In 2008, we had a mini version of this. At the time, it seemed like a major version, but compared to now, it's a mini version. But all the money came out of the money tree into the that stayed in the financial system, and it created inflation, but only inflation in asset prices because the money stayed in the financial system. It was basically monetary stimulus, and we didn't get the fiscal stimulus to drive it into the real economy because we had gridlock between the Republican Congress and the Democratic administration. They couldn't agree. So the money didn't go in the real economy. We didn't get consumer price inflation, but we got asset price inflation. This time around is different because now, in addition to the money going into the financial system, and in the short term bolstering the stock and bond markets, we also have money that's going directly to people who are unemployed, people who are getting stimulus checks, companies, small businesses, and this is different than before. Right now, it's helping to fight the deflationary forces of the pandemic. And rather than going into a steep deflation, it's keeping inflation above zero. If this were to be overdone, and if more and more stimulus rounds were to happen, then this could cause the next inflationary wave down the road, but that's for another day. So Fritz, we think our job is to recognize that this modern monetary theory or magic money tree, which is only a theory, is now reality. The philosophy is the opposite of what we all grew up knowing, which is you work hard, you save, you invest, and take the pain in the short term, but you have a better future in the long term. And the philosophy behind this is you do everything you can to make things as comfortable as possible in the short term, and you worry about the consequences later down the road. And so as money managers, it's our job to worry about those consequences on behalf of our clients, to model the effects as it flows through the economy and the markets, and to make sure that our client portfolios are protected.
Excellent. That's really good. I really enjoyed that explanation. So that will do it for us. Steve and I will be back again next week with another edition of our 3Edge Weekly Update. Remember that all of our videos are available on our YouTube channel, and you can feel free to subscribe to the channel, and also feel free to share these videos with anyone who you think might be interested. In addition, if you have any questions or any suggestions for a future topic, please send those ideas along to us at our website, which is 3edgeam.com. So on behalf of Steve, and everyone here at 3 Edge Asset Management, we urge everyone to remain safe and healthy, to stay strong, and to keep the faith. And Steve, thanks again for your valuable insight.
Thank you, Fritz.
And thanks for listening.